What is up everybody, my name is Gifford and welcome back to another stock market video. So for today we're going to be talking about the top 5 biggest mistakes to avoid in your first year of stock market investing. So before we get into it, please hit like to support the video, and if you're interested in the stock market investing, feel free to subscribe. With that said, let's just get on with it. I'll be going over a lot of questions that I'll be asking you, and hopefully you will know the answer to, or trying to figure out and learn what the answers to these questions are. The reason why they're important is because this is all going to help you make money in the stock market, and the more knowledge you have and the more understanding you have is going to give you a better chance of making money in the stock market. This is definitely the case with individual companies. You either have to have experience in the field or have a very good understanding of it previously. Otherwise, you're going to have to do a lot of learning about understanding the business. And if you're not going to put that time into learning and understanding about the company, then it's going to be very difficult for you to understand that company. And when things go wrong and the share price does take a dip for it, well, you're not going to know what to do because you won't understand the underlying fundamentals of that company to hold conviction when it does go down, or even what to do when it goes back up. So the very first mistake is not having a plan for your investing. So it's either going to be low risk or low input, or it's going to be high risk and high input. So low risk, low input is probably going to mean that you're not going to put very much time into the stock market, probably about less than 2 hours a week. With this investment style and the amount of time you're putting into it, it's best just to probably buy ETFs and managed funds on the Sharesies platform. And with the other end of the spectrum, if you want to go high risk, high input, that means you're going to have to put a lot of time into the stock market. So for me, I do high risk, high input, therefore I put at least 10 hours into the stock market and learning about it every week, and therefore I go for high risk companies. So when I mean high risk, it just means that I'm going to be investing in companies as opposed to ETFs and mutual funds, because I'm going to be putting more time into learning about those companies. And if I learn a lot about those companies and pick the right ones, therefore it gives me a greater amount of risk, and it also gives me a greater amount of reward, and that's how you've seen my stock market portfolio grow. But really the main thing here is all about having an overall plan and what you're doing with your investing. How long is the time horizon? It's better to put the time in now before you put any money into the stock market. And the most important part of this plan is where you're going to get your investing money from. I have multiple incomes, so therefore that's where I get my investment money to then put into my stock market portfolio to keep it growing month on month. So the second biggest mistake you can make is that you actually have to like stock investing. A lot of people get into it because they just want to make a lot of money fast and just do a whole lot of gambles onto unknown stocks that just skyrocket all the way up. That works for a very short time, but if you want to do this for a very long time and not have crazy amount of risk, you actually want to make money and get money back from this, you have to enjoy stock investing, understanding the charts, understanding the company, understanding the financials, understanding financial news and what the world economy is doing. While it looks like you're just putting money into a company to see the stock charts go up and down, what you're really doing is investing in that business, and some people just can't be bothered about learning the company. And if you're like one of these people who don't understand the company and how it works and their fundamentals, you're going to get burned and you're going to end up losing money. So an example of this, we're just here on the Tattooed Chef press releases. You have to learn about what they're doing and what the current news is. You might not like it, but you also have to learn how to read financial results. And at the very basic accounting level, you have to understand where the company makes money and how the company displays these in these reports. So the third one is about controlling your emotions in stock market investing. You can't get too emotional with stocks. It's all about fact-based decisions and not about emotional decisions. So once you've read enough investing books, a lot of the advice is how to keep your emotions out of it. Not fall in love with the stock, but buy a stock because of their fundamentals and where their growth projection is going to be. Not how much you like them, how much you like the brand, how much your mum likes the brand, how much your sister likes the brand, your brother likes the brand. Who cares? It's all about the company, its fundamentals, and how much they can actually grow as a company in the future and how much money they can make you. And if you're going to lose a lot of money in the stock market, don't cry. Leave your emotions out of it. Or cry in the shower. Then no one will know. So the fourth biggest mistake is not understanding how the business works when you invest in that company. So I've already touched on this before, but you have to understand the business and how it works, how it makes money, and how it plans to grow. You also have to put in lots of time about learning what the business actually does and some of its technology, understanding where it fits in with other businesses and its sectors. So for myself, I'm heavily into technology because my field of work, I have over 10 years experience in a technology field. So therefore, I think this helps me out quite a lot when I'm making stock investment decisions on tech companies because I can understand the technology or where it's going to go in the future. I have a better chance of success if I invest in something I know rather than something like a bank which I don't know about, because I've got no idea actually how a bank works. I know how to use a bank, I'm a customer of a bank, but I don't know the inner working details of how they make money. So that would be something I'm not interested in all, how they make money, learning about, reading up on the banks. So that's why I don't invest in a bank. So here I have a quick diagram of the people that's really important to the company, and that's the upper management, because this is the people that are going to be directing of where the company is heading and how they're going to be able to grow as a company and where they're going to make money from, and whereabouts the earnings and revenue are going to come from is all dictated by these people here. So in this chart you have the executive chairman, then you have the CEO, which is very important because that's the head of the ship, and you have the other important members like the CEO, the CFO, the CTO, and the CMO. So the fifth one is not understanding financials or how to read them. Now I've briefly gone over this before, but we're just going to show some more examples why financials are actually 100% important. So we're just over here looking at Yahoo Finance, and if we scroll down in its simplest form here, we can see that these dictate whether they miss or they hit their earnings, if the stock price is going to end up going up or down. And again down here we can just see a summary of their revenue and earnings, and really this has a big impact on the company and understanding where these earnings come from. So moving over to Simply Wall Street, when I first started investing into companies, and I still do now when I'm looking at new companies, I go over here to the financial health section, and this really gives me a great summary about how the company's doing. Simply Wall Street is a lot easier to understand than the Yahoo Finance page. So for people that are starting in the stock market, this is a really good way to understand what are the key metrics that you should be looking for, because when you start investing you don't really know. So this is where it starts to kick up a gear in the financial side. If you're really serious about your stock market investing, you have to learn how these SEC filings are. So here we're just going to look at Tesla's 10K form, and while you don't have to understand all the numbers and figures, you have to understand where they're generating the money, because that's what keeps the business going. So I'm just going to scroll through and show you how in-depth it actually gets. So those are the top 5 mistakes that you have to avoid if you're really serious about stock market investing. In my first year of stock market investing, there's many more mistakes that I've done, but those 5 are the ones I really want to highlight, because those are the ones that can cost you a lot of money. Basically, you have to put a lot of time and effort if you want to make money from the stock market. It's not easy money. It's a lot of hard work, dedication, planning, and making sure you do all the groundwork so then you can profit from the gains of the stock market, because there's a lot of people there ready to take your hard-earned money. And none of those mistakes relate to looking at the stock market chart, because whether the price goes up or down on that chart doesn't really matter the short term. It's all about what the company's going to do long term and how its fundamentals are going to go. The stock price on those charts doesn't really replicate how the company's performing, and it's just all noise and distraction, and therefore you should concentrate a lot of your efforts about understanding how the company works. So anyways, I hope you found that helpful for the mistakes to avoid. I've done my very best to try to make only small mistakes, even if I make a lot of them. This has all helped me to have now a portfolio over $40,000 in my first year. It may momentarily go up or down, but in the long term I'm hoping that this portfolio just keeps on going now that I've started my stock market journey. The stock market can be very ruthless for the people that don't know what they're doing. While you can get lucky sometimes, eventually if you don't learn and understand how things work, it's just going to rob you of your hard-earned cash. And if you've watched the video this far, thank you for watching. As always, make sure to do your own due diligence in the stocks that you buy. And if you want to start your own investing journey from New Zealand, I have links down below. And if you want to follow me on Instagram, I do some posts there weekly, so feel free to follow me there. With that said, safe investing, and I'll see you on the next one. Goodbye.